Welcome to Advisor Talk with Frank LaRosa. Brought to you by Elite Consulting Partners, it's the only podcast offering unfiltered guidance and direct advice for all things concerning financial advisors, RIAs, and the practitioners in the wealth management business. Learn more and subscribe today at eliteconsultingpartners.com/podcast. And now, here's your host, Frank LaRosa.
Hey everybody, welcome to Advisor Talk with Frank LaRosa. I am your host, Frank LaRosa, and joined every week or so by my co-host and Executive Vice President of Elite Consulting Partners, Stacey Frank.
Hey everybody,
How you
happy
doing?
to be back.
Happy to be back. We're wearing green. This wasn't planned, but we're both wearing, I guess, a different shade of green.
Yeah, it's Green Day.
Anyway, so this week we are going to maybe get a little bit controversial. Not maybe. We're probably going to get a little controversial here.
That's intentional.
Yeah, intentional. Otherwise, what would our show be if it wasn't controversial, right?
Right. We have to create curiosity and
our
shock
truths.
value.
Right. Exactly. Stacey Frank being Frank and Frank being Frank. So we're going to really be frank with you today.
We'll be frank with you today.
And we're going to talk about the I think the misconception and understanding about whether or not PE money is good for you or not good for you. And hint, we're going to tell you that may not be as good for you as you think it's going to be, right? That's where we're going to go with this thing.
Well, I think we talked about timing, reasoning. What are you planning to use the money for? What is your timeline for ultimate retirement and succession? I think those are some of the categories that we touched on.
Yeah, and a lot of this is coming from some conversations that we've had with some we're having, I should say, with some of our clients that are looking at PE deals and starting to see some cracks, some like chinks in the armor, right? From what everybody else is saying, like, oh my God, I got a 15 multiple. But they don't tell you all the downsides of what it means to take a 15 multiple. And I was at a group recently, a business entrepreneur group that I go to, and this topic came up because there's some they're not financial service oriented firms. They're all different types of businesses from all walks of life, metal packaging company, a hotel and restaurant owner, like all different businesses. And so this topic came up about, do I sell? Do I not sell? One guy said, I'm really tired and should I take a deal? And then there was another guy that said, hey, I took a deal and I regret it.
It's such an emotional decision.
Right.
Just like transitioning or moving to independence, deciding who your successor will be or who's going to acquire your practice is a milestone in your business.
But I think it's actually more emotional. And this guy that was making this comment said, yeah, I took a deal and he still worked there. Right. Now he took a larger deal. So he sold the majority of his business. But what he said was it was hard to see the culture of the firm changing and he didn't have as much control over it anymore. And he said where it was really hard to see was the effect it had on the employees. And he had the money and a couple of his key employees got money. But the new firm that came in didn't have the same history with the firm building it from the ground up. And I think that that's the same thing that we're seeing in financial services is there's a lot of smart money coming into the business, right? And it's smart money. So they want to buy your practice or your business. I'm saying practice, but it's, an individual practitioner or a company, right? Or an OSJ or
an enterprise.
An enterprise, right? But why do they want to buy your practice? Because they see the growth of the business and they want some of that.
Right, and that's what the PE firms, when they do an analysis of whether your business is going to be profitable or not, we call it the growth trajectory. That's a tongue twister there. They're assessing the growth trajectory and the future recurring revenue of your business. So if you're a thriving practice or enterprise, the PE firms are going to really line up to want to be an acquirer of your business. So maybe, we have conversations with our advisors. Maybe you should think about maybe you should benefit from that level of growth in your practice.
Well, right. They're doing an analysis and they want to buy the firms that have the best growth rates so they get a return on their money, right? But if they're getting a return on their money, you're not, right? And I was talking to a firm yesterday an independent broker dealer yesterday, and I asked them, because they're looking to do business with us, and one of the questions I want to know is, where are you at in terms of PE money? Are you going to be doing an acquisition? Are you going to be selling off a piece of your business, selling off the whole thing? Because when we talk to these independent broker dealers that are 400 or 500 advisors or smaller, we have to assume that at some point they're gonna sell at some point, right? And his comment to me, and he was also a producer at the same time, so he had two different perspectives. His comment to me, which is accurate, which is something that I've been saying for a long time, is, well, they're just paying me with my own money, right? They're just paying me with my own money. And what he meant by that, which is the math that you actually were going through with one of your clients recently, is the money that they're going to give me for buying 20 or 30% of my practice, I'll get that same amount of money if I just build my business the right way
and stick around
and take the cash flow for, what tends to be 5, 6, or 7 years, that you end up making the same amount of money. And so, your advisor was talking about how much growth he was, right?
Yeah, I mean, the practice is growing, gosh, like he claims 15 to 20% a year. And the analogy he uses, Stacey, I just back the truck up. I'm gaining clients left and right. He's in with a niche of clients that he's the guy. It's a very specific niche of client. So, he wants the multiples. He's enticed by the idea of the money. But in the end, when he thinks about it, it's really, well, I can just benefit for the next few years if I stick it out myself.
Right.
And so he's right. And so my question to him was, well, what's the urgency for you to take this money? What's the reasoning? What's the value that you're putting on having that money today versus 10 years from now? So those are some of the conversations that we're having.
Right. And so our warning to you all is just be careful what you wish for. When you do a deal with a PE firm, and I'm saying a PE firm, it doesn't necessarily have to be a PE firm.
Family investor.
Yeah. Candidly, the firm that you're with, right? There's a lot of opportunity now that, and I'm not picking on anybody in particular, but whether it's LPL or some of the other independent broker dealers out there that are buying into the practices of the advisors that are on their platform, you need to be careful what you wish for, because those contracts are hard to unwind, right? And now that firm has sort of captured you, right? They've locked you in. And generally, if you want to get out of it, if the contract even allows for that, we've seen some of our worst cases are when you have a practice sells to an RIA and and then you're trying to get out of it because they weren't delivering on what they said they were going to do for your clients and for you, right? And then you try to unwind it, and it's very, 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 very difficult. They don't let you have like a redo.
I think one of the biggest hurdles I've come across, specifically with RIAs, is advisors that have built their business from the ground up. They run their investments or their models a very specific way, and they want another firm or the acquirer or the PE firm to come in and do it exactly the same and put a tremendous multiple on it. What I'm finding with a number of different cases at the moment is that the advisor or the RIA is not willing to change those things. Right. And so they end up with a little bit of paralysis by analysis. And I'm finding they can't make a decision, but in reality, they're just so protective of what they've built. And in their mind, no PE firm or no amount of money can change it.
Right.
We're not here to criticize that, but that is a huge component.
Yeah, no. I think we've talked about that before in terms of if you want to prepare your practice for a sale, that's one of those issues,
Give
right?
a little to get a lot, maybe, or
right.
not.
But we're not suggesting that you don't ever sell, right? At some point in time, it's going to make it right for you to do that. And you have to analyze, is it sort of like what you're telling your client, is it the right time to do that or not? So if I can just change the lens for a second, if you are in that place where maybe you're 5 years out of your career, meaning you're looking at it and saying you're going to retire, you truly are going to retire, in 5 years, I believe there's no reason for someone to want to retire in their 60s even late 60s. Just run the business differently, right? But in the instance that you are thinking about a transaction down the road, this issue that you just brought up about they run their own money. Like, I know advisors like to run their own money. They're proud of it. They're proud of their returns. I don't think you understand the negative impact it has on a potential sale of your practice.
It reduces the value.
It reduces the value.
Tremendously.
Right.
Yep.
Because you are unique and your thought process and how you invest is unique. This particular client that Stacey's talking about,
this actually,
right, is their model is very unique. It's all they want to talk about when we go there. Like, hey, thanks, but I don't really care. I'm sure it's great and you've been doing it for a long time, but it's going to be very hard for a buyer to come in and replicate what you're doing. So it's creating a problem. So much so that they were actually given the number that they asked for. Like, they asked for, I'll just say north of $10 million. Right. I don't say the number, but
a few million more than that.
Yeah, it was several million more than that. Yeah. Like, the firm went over and above to give them the number, but the firm couldn't address the issue of the portfolio management side of it, and the deal blew up. Yeah,
the human capital piece keeps getting in the way.
It keeps getting in the way.
Right. Finding the right person to maintain that consistency is a major hurdle. Yeah. Because there's no perfect solution.
So what you're better off doing in that case, if you take this train of thought, right, is find a G2, and I'll say G2 because that's the fancy way to say it, but find a successor internally with your organization. And that person, there's ways to find capital to do that. Whether it's Live Oak Bank and other lending institutions, or traditional banks will lend on that business, get an SBA loan, and you're going to get a lower multiple, but maybe that's better off because and maybe it might not be a lower multiple if you're willing to spread out the seller's note for a longer period of time, so you're more involved. So there's ways to accomplish that without giving up total control of the business and without basically losing the culture for your employees and for your clients that you built that made you successful. But more importantly, I mean, that's important. But I do feel like if your business is growing and, I don't want to talk politics, but I don't see the markets slowing down anytime soon. So if you have a really good financial advisor practice, it's probably going to keep growing. So why give that growth to some other firm that hasn't earned it, right? If you are looking to take, you want to take some chips off the table, try to find someone internally. Or if you do want to take some PE money, you need to be really mindful about the contract that you're signing and understand what your risks are, what your exit options are if it doesn't work out the way you want. Are there clauses in there that you can get true ups, right? I think that people don't understand that you can do a deal that pays you today and then gives you sort of a true up after every couple of years if the practice is really growing. Because if you have a practice that's growing at 15, 20, 25% a year, most buyers, also I won't use the word PE, but most buyers will pay up for that because that's the only way they're going to get a real rate of return on their money is to buy that practice, and you should be getting a premium for it.
Right, but back to the taking some chips off the table.
Yeah, right.
I mean, that's really a personal decision. It's a business decision, but it's a personal decision to what is that capital going to be used for? Maybe it's to put more money into the business. Maybe it's for personal reasons, to purchase another home or remonetize some of your personal finances, whatever it is. But be okay with, and we're not going to criticize, but be okay with your reason, your personal reason for taking that capital. But you're going to have to give a little, be a little bit more flexible with what you've always known your business to be.
Right.
And it's okay if you want capital. We all need capital for different reasons. But just understand what the parameters are around that.
Yeah, look, even if you're in your mid to late 60s and somebody's willing to give you, I'll just pick a number, $25 million for your, $6 million business, right? That sounds great. And it is. I mean, I'm not saying $25 million is not a good number, right? But if you're already doing $6 or $7 million in production, in revenue, right? You're well off, right? You probably already have the summer house and the lake house, or the, like you're doing okay. You're not hurting. These are 1%er problems that we're talking about here. What you don't anticipate is if you sell your practice and you have that money in the bank, but all you've ever known your career is building that company, working with those clients, dealing with your employees, and that goes away. There's an emotional side of doing this and this transaction that you can't quantify. And that's where we're seeing some clients post-mortem of a deal regretting their decision. And I've had clients say, I wish I could just give the money back. And that's they can't powerful. Because the firm doesn't want to give the money back because the practice is growing at 25% a year. And so they're like, yeah, no, we're not going to do that. You can leave, you can go start another business, but you can't have this business back. And it's a terrible, terrible position to be in. And I would just sort of why we're doing this, I would just be really careful with what you think you want just because you hear everybody else doing it. Right?
And know what your reasons are. And that's why having conversations with us, the Elite Consulting, is so critical to take the money aside, right? Money aside, what are the reasons that you need that capital for, and be okay with the changes that it might incur. And I'm not referring to the sale of your entire business, but taking 10%, 20%. What's your genuine reason why? And does that capital accomplish those goals?
Right. But even if you sell 20% of your practice, you now have another owner in your business.
Correct.
That you didn't have before, that you now have to, you can't do things the way you wanted to do them before because you now have someone that owns 20% of your practice.
And you have to ask permission all of a sudden.
Basically, all of a sudden you have to ask permission, right? I've gone through that with my companies, right? And so it's different. We have a marketing company that we do all social media and branding for RIAs and independent broker-dealers. And I have, 2 minority owners of that business. And I just can't operate things the same way as I can with a business that I own 100% of. And I've always suspected that, but now that I actually have these minority partners, and it's not that we have any problems, we don't, but it's just the fact that it's there.
Well, you have to play nice in the sandbox.
You just have to, I just can't make decisions like, I'm going to do this, or we're going to do that, or we're going to buy this, or we're going to do, it's just not the same thing. And so just be really careful. You've worked hard for your practice. If you look, here's the reality, and we're going to cover this on the next episode. So you want to make sure you keep watching. If you're looking to take some theoretical chips off the table and you're doing your $5 million practice and you have, $1 billion in assets, right? This is going to sound a little bit, self-serving and a little bit sort of, cold or whatever, but just move firms, right? Just go to another, there are firms out there that will offer you 100 basis points or more on your assets to move firms. So you're going to get 100 basis points, right? So
you're not selling. So you're referring to
selling. So you're not selling. So you're going to move, and you're going to get millions of dollars to make your move, to keep working with your clients, to keep working with your employees, to keep growing your clients, bringing referrals in, and you put several $7 million in the bank that you can potentially then do other things, right?
Right.
Like for instance, you might say, well, I have a G2 that can't afford to buy me out.
Which happens a lot.
Right. Okay, well, maybe that G2 is doing a lot of the work for you. So if you make a transition, you take the lion's share of that money as sort of like a theoretical down payment because that person's going to do a lot of the work. And then there's some back ends. You can manipulate and use the transition deals that some of these firms offer to accomplish something similar.
So in place of use a transition comp in place of a private equity firm coming in with ownership.
Right, exactly.
Yeah.
Or let's say you have 2 partners and let's say they're 50-50 owners, but one partner wants to retire, right? And the other one doesn't. So if you're going to get, let's say you're getting $5 million in a transition and you're splitting that $5 million 50-50. So the advisor that's going to stay on board can use that $2.5 million as the down payment to the retiring advisor to buy that other 50% of the practice, right? So there are ways to do this that you don't, and I'm not going to say it this way, but I'm going to say it just for purposes of understanding, like signing a deal with the devil, right? I'm not saying PE firms are the devil. I'm just saying
disruption. You're referring to just some sense of disruption.
And on the next episode, we're going to talk about is how much different are these firms really, right? How much different is different? And we're going to get into why not too much different anymore. But so the point is, if you're looking to do that, if you're looking to have some type of monetization event, but you're not ready to get out, you're not ready to give up the reins, just move firms. I know that sounds self-serving, but in today's day and age with e-signature, your clients, you're already independent most likely. So your brand is your own brand. All you're going to tell your clients is you're changing the operational back end of how you run your practice, and they're going to sign the forms. It's not as hard as you think it is anymore, especially if you haven't moved in a long time, right? I'm working with a client right now that's moving out of that is at an independent firm that they went to from a wirehouse firm years ago before all this protocol, non-protocol mess, right? So their impression of what it's like to move is skewed because of when they moved firms when it was much harder to do, right? And technology wasn't where it was, and there was no e-signature and all this other stuff. So, and when they moved, they were doing a lot less in production. And when they went independent back in, years ago, there was really not a lot of money to move to go independent. So now they're in a position where they're recognizing we can make a move, we can do it much easier, and we can monetize without actually selling any of our business, right?
So I'm just going to point out the difference. You're talking about monetization versus transition dollars.
Right, exactly.
Two totally separate things.
Right.
But you can monetize with both avenues.
Right. So, that's why if you speak to a firm like ours or, some of the other consulting firms out there, we can help you work through these things, right? We can help you just sort of dig deeper into why are you interested? Like, because my buddies did it. Okay, well, why? Why do you? Well, it's 15x. So what does that mean?
15x on what?
Right, 15x on what, right? But so what's the purpose of doing it? Well, because I'm taking chips off the table. Why? Like, why are you taking chips off the table?
I need capital.
Right, why? Right.
Right.
Why?
That's a rhetorical question.
Right. But so why is a great question, right? Why? Well, because I want to, I want to use the money to acquire more practices. Why? Because you have to understand what it means. So anyway, we're beating a dead horse. You get the idea. If you're thinking about doing something like this, or you're talking to firms, understand the math, understand how it works, understand the risks that you're facing, and really understand what the break even is on the deal that you're getting, right? So what is your net income versus, so what is your net income today? How much are you going to sell of that net income? 25%, 30%. And then how much are they giving you up front, which is essentially your money anyway? And how many years of net income would it take for you to make that much money?
Right. And there might be a period of, if I stay on for 3 years, I'll make that money anyway by doing nothing.
There will be 5-6 years, right? Now, you also have an advisor that you just did a transaction with that he's done. Yeah, I do my deal, right?
Yeah, well, they're in there. The advisors are, late 60s, early 70s.
Right.
They didn't have a successor. We were able to identify the human piece, the actual, 40-year-old advisor that was in their region, and they're out at the end of the year.
Right.
I don't want to say it was easy, but they didn't have any expectations of what their practice needs to look like. They just wanted to be taken care of, their families, and they wanted their clients to be taken care of with a successor.
And they were out at a year.
At the end of this year,
right.
They'll be done.
This person knew I want out
right
at the end of 12 months.
That's where the
So there is no break-even analysis. Right.
There's no disruption. It was, thank you, sell my practice.
Right, exactly. So if you're in that situation, by all means, you should consider some of those deals. And we work with those. So again, we work with these firms, right? That are that have a ton of capital and want to buy practices, but we're just not saying it's for everybody. And so we're just asking you to pay attention before you make a colossal mistake that you cannot unwind. So with that said, thank you for listening. If you are talking to those types of firms or you're interested in exploring whether that's right for you, always feel free to reach out to us. You can call Stacey or email Stacey at
Stacey@eliteconsultingpartners.com. Stacey, don't forget the E. My number is 856-816-6322, or you can call Frank, email Frank at...
Yep, it's Frank at eliteconsultingpartners.com, 856-316-4651. And I would ask, if you have a buddy, friend that is going through this process, just share this video with them because it might help. Might help them clarify.
Definitely someone that doesn't have a succession, someone that doesn't know who their person's going to be, because we've seen issues with that as well.
There's a solution to everything anyone's trying to get accomplished. And so what we try to do here is really get down to the nitty-gritty and the real personal, granular reasons about why you're doing something. Because if we can really understand why, we can solve that problem. Because it may not be what you think it needs to be. Losing as a business owner, control of your business is very hard to replace. And so, and once you sort of go down that road, it's hard to unwind. Anyway,
awesome. Thank you, everyone.
Thanks for joining. Bye.
Thanks for listening to Advisor Talk with Frank LaRosa. If you're looking for more advice or solutions on any topics in the financial services industry, or you just want to subscribe to our podcast, head on over to eliteconsultingpartners.com/podcasts.